Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen. Hello, everyone, and welcome back to the CreditSights No More, Risk Better podcast. This is Winnie Cisar, Global Head of Strategy at CreditSights. And today we are going to take a ride into the auto sector with Todd Duvick, our Head of Autos, and Jim Williamson, our Senior Autos Analyst, leading coverage of the Euro market. Todd and Jim, thank you so much for joining me today.
Good to be here.
Yeah.
All right, so let's do it. Let's open up with a little bit of a speed round. I would love to know the CreditSights 2026 car of the year. So I was looking online earlier, and Motor Trend apparently named the Volkswagen Golf GTI/R. Not familiar with this vehicle at all, the 2026 car of the year. And then the Dodge Charger took the top spot for the North American car of the year. Todd, what is your CreditSights car of the year pick for 2026?
Okay. Well, I'm going to go in a different direction since both of those cars are made by companies that Jim covers. I'm going to go with a brand as opposed to a car with Cadillac, which is owned by General Motors, mainly because, yes, they've got compelling electric vehicles, but they're also launching a team in F1 racing this year. So I think it's going to be a very interesting year for Cadillac.
I love that. Kind of a throwback to the nostalgia of Cadillacs being kind of the supreme. That's a great pick. Jim, what is your pick for the 2026 car of the year? Do you agree with the Volkswagen Golf GTI?
I don't actually, but I actually agree with the other one, which is the Dodge Charger, actually.
Okay.
It was one of the discontinued models from Stellantis a couple of years ago, and it's supposed to be, the starting of a revival of the Stellantis business model. So we'll have to wait and see how well it's received. But
Stellantis could definitely use a little kickstart. So I'm sure that they were happy to see that car of the year nod for the Charger. All right, so let's get right into the broader macro and demand environment for vehicles this year. Todd, I'll start with you. Last year, we saw some interesting idiosyncratic activity in auto buying, especially in kind of the latter stages of Q3. There was that end of the EV tax credits that drove a nice little burst in purchases in the US. How are you thinking about the outlook for light vehicle sales this year? And then what are some of your assumptions in your forecast?
Yeah. So it's been an interesting time, to say the least, in the auto sector. We actually saw retail sales in the U.S. exceed expectations last year for two reasons. One was with the tariffs that were implemented in April of last year, you had a lot of consumer buying ahead of the expected price increases related to the tariffs. So that was one factor. And then the other factor was really the electric vehicle market. With the U.S. change in policies, eliminating the $7,500 tax credit to purchase an electrified vehicle at the end of September, you had a lot of buying ahead of that expiration, especially in the third quarter. And what we've seen since is kind of a really tapering off in terms of EV demand. So we've got that headwind coming into 2026. However, we think that you're going to see continued growth in hybrid vehicles and probably steadier growth in ICE vehicles, or at least steady demand as opposed to declining demand. And so we think that this year we're going to see pretty similar retail demand in the U.S., maybe a slight decline because you're not going to have a repeat of those one-time effects from 2025.
All right. So kind of steady, but maybe a little bit of a mix shift in terms of the composition of those sales transitioning away from EVs more towards hybrids, finally having their day in the sun and ICE vehicles. So Jim, do you have a similar view for Europe? Are there some differentiating factors in Europe versus the US for light vehicle sales?
Yeah, so I mean, somewhat shockingly, I think when you look at the big three markets now, Europe's probably one of the more resilient actually these days, compared to particularly China, but also the US as well. In terms of the drivers, I think not a lot's changed. Affordability, is clearly still the constraining factor in terms of, preventing more growth. But just given the magnitude of the price increases that took place in those early years of the post-pandemic recovery. So, while obviously geopolitical volatility is still a bit of a dark cloud hanging over Europe, all in all, there's some positives and negatives, I would say. Um, lower interest rates will definitely help.
Yeah.
At the margin, we've seen ECB cuts throughout last year. Economic growth is holding up probably a bit better than a lot of people would have expected, and there's still potentially a bit of a positive fiscal impulse coming in terms of the more expansionary fiscal policy in some of the key regions, but particularly in Germany. So, hate to be boring, but rather be boring than wrong. So I think it looks like another year of probably flat to slightly higher volumes again in 2026 in Europe too.
All right, well, that's encouraging. And I don't think that that's boring. I think that that is just prudent forecasting for sure. I always tell my kids that only boring people can get bored. So, I think that you're continuing to keep yourself entertained in the Euro autos market. I think it's really interesting as well, and this is something that we've heard quite a bit, is kind of the macro view for Europe. Feels like people are a little bit more constructive than for other regions, including the US. And I would say that that is really kind of upending a lot of the conventional wisdom around US versus Europe macro fundamentals. So, Todd, Jim spoke a little bit about the affordability piece, and that has clearly been a pretty significant thorn in a lot of consumer sides for quite a few years. I know that average monthly car payments have just continued to be at very elevated levels, although it seems like they have not accelerated further. Is this affordability issue still going to be a significant headwind or key trend in 2026? Is there some relief in sight?
Yeah. So, we think it's not necessarily going to be a headwind, but we do think affordability is going to continue to prevent the market from getting back to the pre pandemic levels, which was about 17 million vehicles in each of the 4 years prior to the pandemic. Last year, we ended the year in the low 16
Hmm.
million range. We think we'll get close to that again this year, but that's still a million vehicles lower than pre pandemic levels. So, on the one hand, we think that, yes, affordability is the factor that is constraining the return to the 17 million. However, we think that, there's still going to be some price inflation in the auto sector this year.
Hmm.
Um, but that's going to be partially offset by a couple factors. Number one, as Jim mentioned, interest rates. If you take a look at the average interest rate on vehicle loans, it's actually lower year over year
Hmm.
by about 40 to 50 basis points.
Hmm.
We think that's going to be supportive of demand. We also think that the U.S. and the big, beautiful bill that was passed this past summer of 2025 made a provision where the interest expense on a vehicle manufactured in the U.S. can be serve as a tax deduction
Hmm.
within limits, but still on the margin, we think that's going to be supportive of demand. So affordability is a factor, but we think uh, the number one factor for car purchases, which
Hmm.
most of the vehicles are financed, is going to be what is the payment, as you mentioned. And so
Hmm.
if we see prices increase, we think maybe 2 to 3%. That's going to be offset by the lower cost of financing. So the payments we
Hmm.
think are actually going to be about flat, which is going to be somewhat constructive
Hmm.
for the auto sector in 2026.
Yeah. So Todd, just like looking ahead to kind of some of the out years, if we're continuing to see new vehicle sales that are, 1 million less per year than pre-pandemic, that feels like it has some implications for the used car market in, 2, 3, 4, 5 years with some continued tightness in terms of used vehicle prices.
Yeah, no, I think that's a great point. And if you take a look at what happened during the pandemic, that is supportive of the used vehicle market as well, because
Mm-hmm.
there weren't any leases being made like 3 years ago, and so the number of
Mm-hmm.
off-lease vehicles coming into the used vehicle market is lower. That's been
Mm-hmm.
very supportive. But
Mm-hmm.
to your point, with lower sales on the margin, what that's going to mean is lower numbers of vehicles coming from the initial owners into the used
Mm-hmm.
vehicle market.
Mm-hmm.
That's going to be partially offset by the fact that the average age of vehicles continues to creep higher, meaning that vehicles are
Mm-hmm.
lasting longer because their
Yeah.
quality overall, especially compared to 40, 50 years ago, is
Mm-hmm.
much higher. So, uh, but overall, I agree with you. I think that is going to be supportive of the used vehicle market, which is exceedingly important for not only the automakers in terms of residual values for leases, but also like the car rental companies.
Yeah, absolutely. So, Jim, in the Euro region, how are you thinking about affordability? Are there any different drivers there? I presume the one big beautiful bill act interest deduction is not a material consideration for you.
Yeah, I mean, I think in Europe there's kind of two conflicting forces at play. The the first one is that there's generally still a bit of a reluctance from the OEMs to give back on pricing.
Hmm.
But on the other side, consumers love to spend. So long as the economic backdrop holds up, I think there's not really any reason for that to change. But if you were to kind of tell me that either volumes or pricing one had to give, I actually think that the automakers would be a bit more inclined to give on the pricing than they would on the volume at this point in Europe. And that's because of low capacity utilization is probably the biggest challenge for a lot of these companies when you think about like the structural concerns in the industry. And so I think at some point, as Todd mentioned, we're still below pre-pandemic levels in terms of volumes. There is an incentive to try and keep volumes up as much as you can, given we're at this low base. That's not to mention the fact that there's also a whole host of Chinese companies that are, lining up at the door to fill any void left by an OEM, if they're not willing to budge on pricing. And then I think the other aspect is, coming around to the financing angle is that um, you know, that obviously plays a huge role. As we mentioned, rates have come down, and there has been also some increases in incentives, from these financing units to try and keep, the volumes rolling along. But there's also the potential for some more, creative financing to come to the fore in terms of, we've heard trends about, the extension of terms in terms of loan terms. Whether or not that's a good outcome for the consumer to have a car loan that's extending out, 7, 8, 9, 10 years, remains to be seen. If one thing it does mean is that it's more profits for these for the financer, and given lots of these companies own their own captive financing units, then it's another potential tailwind for the industry.
Yeah, absolutely. I think that the extension of loan terms both in the US and Europe is really fascinating, given that it is a highly depreciating asset in used vehicles and new vehicles, especially when you drive them off the lot. And even with some of that supply constraints, makes me a little nervous. Feels like some negative equity will be rolled into the future. So, one topic, of course, that has been very front and center for the past year, deregulation. And Jim, I'm actually going to start with you because I think we all know that the Trump administration is very focused on deregulation across a wide range of sectors. But Jim, I think that within Europe, we're actually seeing some changes in the regulatory environment as well. What are you seeing and how are you thinking about it kind of changing the game for European OEMs?
Yeah. So I would say for the first time in probably a decade, we're starting to see a bit more of a balanced approach being taken for regulation in Europe. for a long time, it was heavily focused on decarbonization and the environmental side. And that's part of the reason why we kind of got into the situation of a 2035 hard stop where, to only sell EVs by 2035. Even though it's, over the course of the time that has been in place, it's been pretty clear that the demand is just not there for, the penetration rates are not high enough for fully electric vehicles. Hybrids may be a different story, but fully electric, the demand just isn't there. So there's been a few measures that have been implemented by the European Commission, over the course of 2025. We've got what's known as like a bank and borrow system in place now, 2025 to 2027, where essentially an OEM can kind of make up any shortfalls of emissions misses in the later years. They have now already signaled there's going to be a similar system 2030 to 32, which also helps. But I think the big news is more around the fact that they're proposing now to pull back from that hard deadline of 2035. So the 2035 deadline is still in place, but under the new proposal, the OEMs would only need to reduce their emissions by 90%, versus 2021 levels, rather than the 100%. And so what it means is that, these OEMs can sell, vehicles that rely on things like e-fuels, or also potentially hybrids for a lot longer than they otherwise would have. We can argue whether or not the rolling back of it has been goes far enough. And to be honest, if I was a betting man, I would say that this won't be the last time we see these standards eased. But I think it somewhat misses the point. I think it's more the signaling aspect that matters a lot for investors at this point. Because for a long time, the European Commission really shot down any hopes of pulling back in terms of the regulatory environment. And that's caused quite a lot of investor angst over the years, as we've kind of led up to these incremental deadlines, whether it be 2020, 2025, and the fact that we've got even more stringent ones coming up. So I think what's clear now and is important for investors is that logic is starting to prevail in some respects. And, while the environmental aspects are still at the forefront, they are being now considered alongside some of the economic realities, which I think is a big transition from where we were even just a couple of years ago. In terms of like winners and losers, honestly, I believe like the whole sector is a relative winner, because the legacy OEMs have been placed under massive financial strain, due to the regulatory induced investment commitments for, as I mentioned, the best part of a decade. So, we're talking about capex profiles that have regularly exceeded like 10% of revenues. OEMs have had to retool factories. They've had to invest in battery production. There's been huge R&D investment to develop and launch EVs. And so, the kind of bottom line is that it's going to provide a pretty decent opportunity for, some retrenchment on the investment front. And that should start to flow through into, slightly better margins and free cash flow, as we go through 2026.
Yeah, I mean, better free cash flow is always what we're looking for as credit investors, for sure. So, Todd, how about in the US? Of course, we know that there is this kind of move away from a true focus on EVs. How are we thinking about that shifting focus, and how will it impact the profitability of the US OEMs?
Yeah, it's a great question. So it's clearly going to be a positive movement for the automakers in terms of profitability, because EVs, very few have companies in the U.S. or even any of the competitors from outside the U.S. that are selling vehicles in the U.S. are making money on EVs. We've heard from Hyundai that they have been profitable on their electric vehicles. But if you take a look at Ford, losing $5 billion in EVs last year, second year in a row, that's not a good thing. So if you take a look at what has been done in terms of policy for EVs in the U.S., they've removed the consumer tax credits, but importantly, the manufacturing tax credits that were part of the Inflation Reduction Act are still intact. So that's going to help support companies like Ford and General Motors in terms of reducing the cost and helping to defray some of the costs because they're going to continue their electric vehicle efforts, but just not as aggressively as they have been. But I think, that coupled with the fact that the emissions regulations are expected to be rolled back. We've got the proposal that we saw, which is basically to continue to increase the emissions reduction going forward, but the target is much more realistic than it had been previously.
Mm-hmm.
So I think that's going to be beneficial. And the other key factor is they're no longer going to be subject to penalties for missing the old regulations targets, which General Motors stated just this morning. That's going to be a savings of about $750 million for 2026. So we think that, coupled with the mix improvement towards the more profitable ICE and hybrid vehicles, is going to be constructive for these companies going forward. So that's the good news. The bad news is that's going to be somewhat offset by the tariff costs.
Mm-hmm.
But going forward, I guess on a sequential basis, we expect profitability in the U.S. for automakers to have troughed in 2025 and see sequential improvement due to mix shift and mitigation of tariff costs going forward.
Yeah, I think that it's interesting that the auto sector is truly one where we can really be concrete around the quantitative benefit of deregulation. I think there's a lot of headlines out there around deregulation and perceived kind of benefit to expenses and cost savings. But autos, we can really get into the nitty gritty, which I think is super helpful. Todd, this is a really unfair question. I'm going to put you on the spot, but how sticky do you think this deregulation is? Like, we all know that it's very politically driven, kind of with whatever power party is in power. Do you think that some of these deregulation factors are more with us for the long term, or is this something that's going to get flipped on its head if we see, a new party come into power?
Well, so that's definitely a risk. However, I think that there's probably going to be recognition. This is my hope, belief that we've seen the pendulum swing so
Mm-hmm.
far in one direction with the Inflation Reduction Act, and I think that there's recognition broadly now that, as Jim has said, consumer demand for electric
Mm-hmm.
vehicles just is not there.
Yeah.
Um, and I think that there are a number of things that really need to happen. Um, and one of the things that I think could be happening in Europe that could be coming to the US is the introduction of Chinese competition, which are the
Mm-hmm.
leaders in electric vehicles. If if they we can get our costs down on electric vehicles, I think that's one thing. But also you've got the charging. We've got consumers
Mm-hmm.
in the US that aren't willing to spend more time charging a vehicle out away from their home than they are filling
Mm-hmm.
a tank of gas. And so
Mm-hmm.
there are a number of friction points we think for demand. And so I think that the recognition by the Trump administration is that they want to align regulations with where the consumers are,
Mm-hmm.
basically give consumers freedom of choice. And I think in terms of swinging the pendulum back under a new administration, I think there's going to be significant resistance and hopefully recognition that, we can swing back in that direction, but not fully as far as they were under the Inflation Reduction Act. So hopefully, cooler heads will prevail and more of a pragmatism in terms of regulatory outcomes.
I think that that would be great. Cooler heads and more pragmatism across a wide range of topics for sure. So, of course, this kind of brings us into tariffs and trade. And Todd, you did mention it as, maybe an offset to the deregulation positives. We, of course, saw a lot of these headlines dominating the auto sector, especially early in the year where people were really worried about the impact on autos. But it seems like as we have had some bilateral trade agreements put together, the extension of the auto parts tariff offset. Are we kind of behind are the tariff headwinds that were very challenging, are they now behind us, or is there still more to come?
There's definitely still more to come. Um, if you take a look at what has been done, there have been bilateral trade agreements between the US and the UK, Europe, Japan, and Korea, at least until last night, Korea. because Trump was not happy with the Korean parliament not passing the legislation and formalizing it. But that could change. But I think the big thing that needs to be addressed really is the U.S. Mexico Canada agreement, because there are still tariffs of 25% on vehicles coming in from Canada or Mexico that do not comply with USMCA requirements. So we think there's an opportunity for those to be reduced, for those tariffs to be reduced. But that's among the three countries. Currently, the U.S. is in a war of words with Prime Minister Carney from Canada. And so, I think President Trump has indicated that instead of a three-way agreement, he may be more inclined to do two bilateral trade agreements with Canada or Mexico. If not, if they don't come up with either the bilateral or renegotiated USMCA, then it basically takes the old USMCA, which exists today, on a one-year renewal until it finally expires in 2035. So I think that's the big trade and tariff area that we're going to be focused on this year. But in terms of actually mitigating the full costs of tariffs, that's going to be a multi-year situation where it's going to take 2 to 3 years, I think, to really realign the manufacturing footprint, including the suppliers, to really mitigate the majority of those costs.
Yeah, it seems like an expensive and time-consuming exercise to work through all of these different factors. I was in Toronto last week doing some client meetings, and the USMCA just came up quite often in terms of expectations for that negotiation process, for sure. So, Jim, I think that you mentioned earlier the Chinese automakers and kind of their broader impact on the global auto markets. How are they kind of changing how you're thinking about your coverage, both in China and then in Europe and the US?
Yeah, so as I've kind of always said, I think you really need to separate the two different things. The first is that when we look at the Chinese OEMs in China, I think in China we're a lot further through the cycle because you've seen penetration rates of local players, already reach very, very high levels. There's a lot of excess capacity now. There's been a lot of support from government, to get these local players up and running. But now we see, and that's come at the detriment, obviously, of a lot of the Western OEMs, particularly the Germans, who have lost quite a decent amount of market share. So I think now we're shifting into a bit more of a consolidation phase, where where the sector in China is looking for opportunities to consolidate some of the excess capacity and maybe stabilize things a little bit more from this kind of out and out price war that's really taken over of the sector. And I think in the last 6 months or so, we've actually seen the Chinese government in particular starting to step in with a few regulations and things like that, which have actually looking to achieve just that. So some examples would be, several Chinese banks pledged to reduce commission payments to dealers, which was one of the big factors actually that was, fueling the price war to begin with. And then more recently, in a bit more of a direct manner, they've actually outlined new regulations that automakers need to follow. So that includes, importantly, preventing automakers from selling vehicles below their production costs. So that's actually, a pretty clear line in the sand from the Chinese government, that enough is enough from that perspective. And also bearing in mind that, it's a big contributor to this kind of deflationary argument that's kind of taking hold in China at the more macro level. But, with that in mind, we actually think 2026 might, for the first time in a few years, bring a little bit of relative stability for the Western OEMs. BMW mentioned that some of these initiatives that are being undertaken by the Chinese government's already starting to is already kind of visible in the way in the trends they're seeing. So that they indicated that they're starting to see volume stabilize in the kind of 50,000 a month area, which is not as good as it used to be, but still decent enough. But if that does occur and we see some stabilization, then it does end this kind of multi-year period of pain. And I think it would support the investment case of a lot of particularly the German OEMs, where investors are a little bit have been very concerned as to what the long-term prospects are of those companies in China. If we look at the impacts on Europe, now that the Chinese market is heavily penetrated, they're obviously looking for ways to export a lot of that excess capacity, particularly to Europe, as the regulatory burden is not as high as it is in the US. I think on an absolute basis, when you look at the growth numbers of some, particularly a name like BYD, it is impressive, and they're starting to get a pretty decent foothold in some of the markets, the UK and Germany in particular. But I think equally, when you look on a market share basis, we're still talking, low to mid single digits in terms of market shares. And so, to be honest, we're still relatively comfortable with the medium-term positioning of a lot of the legacy players, particularly because I think a lot of the issues stem from the technological gap and the price gap that has materialized as a result of these new players. But we're actually starting to see, that technological gap in particular start to at least close, but probably not completely, but at least to the point where, the switching costs are a lot higher, I guess, to swap to a Chinese OEM. So I think like VW is a good example. So, if you'd been in a coma for the last couple of years and you woke up and read the headlines, you would think that, VW was a deadpan walking when it comes to competing against the Chinese players. But I think when you actually look at the raw numbers, it's not actually that true. For example, when you look at BEVs, even in Western Europe, Volkswagen has about a third of the overall market. And that's pretty much in line with what their overall market share is. So, I don't want to come across like dismissive of the threats. Obviously, this is something that will remain a very, important factor going forward for the sector, and something that they'll need to continue to adapt to make sure that they stay ahead of. But all in all, I do think that a lot of these legacy players are actually proving a lot more competitive than many people would have thought, if we went back 3 or 4 years ago.
That's really interesting, especially. So, Todd, am I hallucinating? Did I see recent remarks from President Trump saying that he might be willing to allow Chinese automakers to sell into the US?
You did. However, the caveat is only if they manufacture the vehicles in the US. So, I think that indicates a willingness, because his push for the auto industry has been to rebuild the manufacturing base in the U.S., and so that would be supportive of that. I'm not so sure that the automakers that have been in close contact with President Trump, including Ford, General Motors, and Stellantis, would be as enthusiastic. But I think if you take a look at that, we wrote a note last week where we think that that makes sense. You've already got BYD with a electric bus plant in California. So they've got some history here. But in terms of the categories, I think probably with their lead in electric vehicles, it makes sense for them to consider coming here with electric vehicles, potentially hybrids, which they also do very well with. And also Geely has expressed an interest in coming to the U.S., saying they expect to make an announcement in the next 2 to 3 years. So, I think that's surprising, because you would think, at least I would have thought, that President Trump would have been one that said absolutely no way to Chinese automakers, and yet he's the one who has spoken publicly, saying, yes, if they want to come, let them come in. So we'll
All
see.
right. I guess more pragmatism, if it's made in the USA, it's okay. So, Jim, you mentioned earlier this kind of interplay between the pricing side of things and the volume side of things. And as OEMs have seen some headwinds from either regulation or tariffs or just kind of lower sales, margins have definitely evolved. We're kind of in this new single digit type territory. Is that the new normal, or do we expect to see some margin expansion?
So I think there's kind of a distinction that needs to be made. Firstly, yes, I think that single digit margins are the new normal for OEMs. But I guess the distinction is that I don't necessarily see that as an inherently bad thing. BMW, for example, they're probably going to generate an operating margin of about 6% in 2025. Some would look at that and say, well, they were making 10, 11% a couple of years ago. The sector's structurally broken. But to be honest, I don't really think that's true. Pre-pandemic, single-digit margins were pretty stock standard in the auto industry. And when you look at the operating performance of companies at that time, they were generally still able to generate pretty decent free cash flow. Again, not to the same level as what you would at 11%, but certainly enough to make sure that credit quality is supported. So if you want to talk and if you want to talk directionally, I think there probably is a little bit of scope for margin expansion. I think the comps on tariffs will start to become a bit easier. Now that we have some of these bilateral trade agreements in place, and there's also a lot of cost cutting that's going on across the sector. VW is making some headway finally with job cuts at the VW brand. Mercedes-Benz is also executing pretty strongly on that front. And as I kind of alluded to already, I mean, the margin side is really only half the story. Autos have been through basically a decade of an investment super cycle, to try and keep pace with those regulatory changes, but also the technological changes, across the sector. But I think all signs are now pointing to those investment needs actually moderating quite meaningfully going forward. So for example, in 2024, VW was planning to spend about 180 billion in the 5 years through 2029 in terms of investment. Fast forward to the plan they've just put out, and we're down to 160 billion. So we're down about 20 billion, which is, roughly just under 5 billion a year. And that's already starting to kind of feed through in the financials. So last week, VW actually pre-announced their 2025 results. Well, guidance had been calling for break-even free cash flow. And they've now indicated that free cash flow is going to be about 6 billion for the year. So some of that's working capital, which, could prove temporary, but part of that's also because investments have come in substantially lower than they previously expected. It's a similar story at BMW where, they're going to see a pretty significant reduction in investment now that their new A-Class architecture is now being completed. So I think, when you kind of marry the two up, if we can get to a situation where we have, margins that are, 5, 6, 7% and, potentially trending at least in the right direction, and then you get an investment profile that's starting to meaningfully decline, I do think that there's, a pretty strong argument to make that, in the years going forward, we're going to actually see free cash flow profiles that are a lot stronger than the market's currently pricing.
Yeah, it's so interesting, Jim. And I would say kudos to you because you were definitely a bit contrarian last year when you were thinking about the auto sector and its ability to manage through a lot of the perceived headlines and headwinds. So, Todd, I want to shift to your side of things because people were really worried last year about auto downgrades. Ford had kind of come back onto the list of a potential fallen angel downgrade. We know that the auto sector in cycles past have had some challenges related to ratings downgrade. And of course, we did get a decent sized fallen angel last year with Nissan. How are you thinking about the potential trajectory for upgrades and downgrade candidates within the US OEM space?
Yeah, it's a great question. So if you take a look at the impact of tariffs, it's definitely had, in several hundred basis point margin headwind on most of the automakers competing, at least that I cover in the U.S. over the past year. As I mentioned previously, I think that that margin trajectory is going to be positive over the next couple of years as they mitigate more of the tariff impacts. But to their credit, the rating agencies took more of an intermediate term view, and it wasn't so much about where the margin is going to be this year or next year. It's where can they get to over the next 2 to 3 years. So that's the situation where, yes, S&P came out February, so almost a year ago, and on Ford's weaker 2025 guidance, they put them on negative outlook, which was concerning because they're low triple B rated by S&P and Fitch and BA1 rated by Moody's. So if they got downgraded by S&P, they would be in the high yield index. So that was in February, and then fast forward to the tariffs, we thought, okay, this could be the factor that actually pushes them over. However, they were more measured in their response to that, taking into account not only the tariffs, but also the potential changes in the regulatory environment, which, if you take a look at the tariffs, I think that's a near-term negative. The regulatory environment is more of an intermediate term positive. And so, when we talked to S&P, specifically about Ford, they were saying that it's less about getting to the 8% EBITDA margin within a certain time frame and more the direction of traffic. And so they are more measured, and that's given us confidence that they're not going to downgrade Ford. And more broadly, we think that there are going to be very few negative rating actions this year. That's our baseline expectation. The one that we think we're most concerned about in our coverage universe is Honda, which has a tremendous motorcycle business globally. Those margins are high teens. But if you take a look at the automotive business, that's always been much lower margin, kind of low single digit margins. Currently, they're losing money. And we think that, with some of their tariff mitigation actions, that's going to be moving them positive. But we think that their margins overall are going to be just burdened such that it's going to be very difficult for them to get back to their 4 to 5% operating margin over the next couple of years. That concerns us. They've got a negative outlook by 2 agencies. We think that's probably our most concerning name. But aside from that, we think that something like GM, which is on positive outlook still by Fitch, could have more positive rating momentum than negative. So it's kind of a mixed bag there.
Yeah, didn't GM report this morning and they're doing
They did.
okay?
Yeah, and the stock price is up 4% pre-market trading, and they expect to get back to the North America adjusted EBIT margin at 8 to 10%, which is a year in 2026, a year earlier than we in the market had been expecting.
Yeah, that's great. Good job, Mary Barra. All right, so Jim, how about for your coverage? Any potential ratings changes that you are expecting?
Yeah, I think I would kind of echo some of the comments that Todd made. I mean, we don't really have any fallen angel candidates, to be honest, in Europe. And to be honest, I think Stellantis is probably the only name where we actually see a relatively high probability of any downgrades, from any rating, to be honest. When we say that, generally the first question is, well, what about Volkswagen? They had 3 profit warnings last year, low single-digit margins and break-even free cash flow. Things weren't looking particularly good, but and I think that there's no question that the company is starting to test the patience of the agencies that have given them a pretty long runway over the last couple of years. But I do think, in the context of the balance sheets that these companies have, in which Volkswagen is included, it does give the rating agencies a lot of ammunition to kind of take a wait and see approach if they continue to be of the view that things are going to get better. And when we think about those moving parts like cost cutting that I mentioned already, the expectation that BEV margin dilution is going to be a lot lower in 2026. and that positive inflection in free cash flow that I spoke about as that investment spend comes down, there's not really any reason for, Moody's and S&P to jump the gun, and be super reactive to things that happen in 2025. I think the agencies in general are still kind of wanting to see what some of these companies look like in a more steady state environment. And to be completely honest, it's not something that we've really had in the auto sector pretty much since the pandemic. Every year we've had some kind of issue or challenge, whether it be macro or micro level, that's kind of throwing things off. And so, because of that balance sheet strength, I think it gives them the ammunition to kind of wait at least for this year and see how things shake out. But I do have a rising star for you if you want one.
Yeah, we love a rising star.
It's already been up. We've been saying it's going to be upgraded for a while, but Renault has been upgraded now once at S&P to BBB minus, and we expect Moody's are going to follow suit probably in the very, very near future. So we think that'll be a fully fledged investment grade company, probably in the first half of this year. That'll make it eligible for the IG index in Europe. And to be honest, when we look at the relative value, we still think there's a little bit of juice left to squeeze in that trade. If there are investment grade investors out there that have the opportunity to dip down a little bit if they're looking for places to pick up some yield. So, yeah.
Sounds like a great core plus trade for sure. All right, so that is one pick that we like. Todd, what is your favorite autos play for 2026?
Well, so I've got two. One is going to be more the safety play, which is General Motors. We think you're not getting near as much in terms of spread pickup with General Motors. However, we still think they're going to outperform the index because they still trade modestly wide to the index. But our overall pick would be Ford. Ford, which I mentioned, is BBB minus negative outlook by S&P. So you're being paid actually for a little discomfort there with the rating.
Mm-hmm.
They still continue to trade. Their notes trade at BB levels. And I think that they're going to report earnings 2 weeks from today. We think that the big mover in terms of the outlook is going to be that $5 billion loss on EVs, which I mentioned last year. So they announced a $19.5 billion charge related to their EV business in December. They're going to take the majority of that in the fourth quarter. That's really going to reset their cost basis for the electric vehicle business, which they call segment Model E, much lower. And they've said that they expect positive trajectory in terms of the EV profitability or loss over the next several years, including starting in 2026. So we think we're expecting a much better outlook, still a loss for their EV business for 2026, but moving in the right direction. And we think that, along with expected lower warranty costs, are going to be the two key factors that we think are going to help support that negative outlook, moving towards a stabilization in their outlook, maybe by 2027. So Ford is our number one pick.
Great to hear. So potentially some good alpha at Ford and kind of a nice carry, sleep well at night with GM. Jim, besides Renault and the potential for a rising star upgrade, anything else hit your radar for what you really like?
Yeah, I don't think it would come as any surprise to anyone that's gotten this far through the podcast, but I think, to be honest, we still think the VW seniors are your best bet in the European IG space. We haven't outperformed on the sector as a whole. When you consider, we think margins are going to improve in 2026, the free cash flow and positive inflection that I've spoken about. When you marry that up with, a pristine balance sheet, very short duration profile, and the fact that you still get a pretty healthy spread pickup to, premium peers like BMW and Mercedes. I think so long as you can kind of get on board with the narrative, our relatively constructive view on the sector narrative, then I think that it's going to continue to be the best place to generate excess returns in a sector that people continue to love to hate. So
always a love to hate, and VW does feel like kind of a poster child for that love to hate sentiment for sure. Well, you and Motor Trend are aligned in your top pick of a Volkswagen for 2026. I appreciate that for sure. Todd and Jim, thank you so much for joining me to talk all things autos. Thank you everyone for listening to our CreditSights podcast. If you have follow-up questions for Todd or Jim, you can always reach out to them using the Ask an Analyst function on the CreditSights website, or of course, reaching out to your sales coverage. Thank you guys for joining.
Thank you, Winnie.
thanks, Winnie.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.